Hey YouTube, it's Dimitri, and today we're going to talk about model development. Specifically, do models actually add value? And if so, how much value do they add? I did a video here on the last 5 years of quant review. This was more or less me talking about being in the industry, some of the issues I saw, transitions between old CEOs and new CEOs and strategy and some of these kind of topics, but I didn't talk a lot about the strategy pieces, and I didn't talk a lot about why I agreed or disagreed with things. And so somebody asked, do you think model development actually does make a big difference? Like, that's the key to winning in the markets. And then they follow up with an exact question on that CEO. Like, do I think that CEO had a valid point here? What they're getting at is we had one CEO that really embraced modeling, that really understood modeling. We passed a lot of regulatory exams. So we passed CCAR. And then we made some really good money. We had some good decisions. In my opinion and perspective, we were moving in the right direction. New CEO came in and wanted to streamline and make things more efficient, and they reduced a lot of the staff here. So the question is do models make a difference, and are they competitive here? I think to do this, we have to take like the 30,000 foot view of banks. So understanding a bank. A bank is a massive, often diversified, often not diversified institutional organization here. So let's first talk about diversification and why this is important inside of banking. No, not in the investing side here. Diversification is going to be the strategies, products, and pieces you work in. So when you take a big, massive global bank, they're going to be often well diversified across multiple products. So when I talk products here, they're going to be engineering, so financial engineering, different types of products. And what this looks like is you might be in the auto business. So you have auto loans, you have mortgages, which are loans for houses. You have credit card products, for example, and you might have a bunch of other things like wealth management, corporate loans, real estate loans for commercial, kind of that business corporate side of that. And you might have other services like investment banking, which is going to be services around mergers and acquisitions, so M&As, again, like de-stress, debt restructuring, those sorts of things. You take corporations on the investment banking side and you provide those sorts of services. And again, the wealth management side is going to be like I'm going to put in air quotes here, the investing side of buying and selling sorts of assets, which is what most of you probably think about when you think about quant finance here. What you don't often see or realize is that there is actually a ton of money in loan origination, credit card debt, all these sorts of debt products here, these loan products, they get packaged, securitized, and then sold to other banks here. So again, you want to have that. To be able to have that spectrum, you need a large bank. Smaller banks, when you go smaller down the spectrum here, specifically at credit unions, they try to diversify, but often they have like a market or a niche, right? If you're a credit union on the corner, I don't know, say here in Dallas, Texas, you're going to be servicing customers in Dallas, Texas. You're not going to have geographic diversification. So you're not covering all 50 states. A lot of these global banks are covering a bunch of different countries. They have actual diversification across geography, product type, as we talked about, and they do a lot of just different services and financial services and transactions. All these sorts of things all compiled in together often reduces their risk. Now, I have worked at regional banks who have had like a one-trick pony, and what I mean by this is they have, so one of the firms I was at, one line of business generated 80% of all of their revenue, and then they had a bunch of other little things here and there they'd like to dabble in, but they were not profitable. They only really knew how to make money in one sort of product here. Now, this is high risk, right? This is not a good decision here. So again, you have bank size plays an important factor in this. Now, when you start to think about this competitively, right? Let's just pretend we're all competitive. We're on the global stage here, and we're all these big banks here. How do you compete? Well, cost of funds is one of these. So how much does it cost you to finance a loan? So let's say I'm going to go out and we'll do a mortgage here. Let's say I'm going to make a mortgage loan to some client. They need, I don't know, $400,000 when they come through the door. I have to get that $400,000 from somewhere, right? I can't just print money in thin air. So I either need to take deposits from a bunch of other customers that are $400,000 worth and do that. I might have investors. So like you have equity in a firm, which is your equity pool. When people originally put money in it as an investor, you have your own sorts of funds internally here that are going to be sitting on the balance sheet. You could use your own funds to do that. There are a variety of debt structure. Maybe you go out and you find someone who's going to issue you a bunch of loans because you need money. Banks can often borrow money much cheaper than other institutions. So maybe you go to the federal funds window. Maybe you end up going to another bank for the loan. There are a variety of ways you can get capital. So you just need to get money. And that has a cost, right? If you give me money, whether it's through your savings and deposits, like your checking accounts, I have to pay you an interest rate on that, which is often the cheapest route. But anyways, you can borrow money and there's going to be some sort of rate with that. So there's going to be a rate that's the cost of the funds to borrow that. Now you have to lend that out to the customer at a higher rate so that you can make a profit or make money on that. So the cost of this, what you're going to pay is going to be the cost of your funds. The interest rate which you charge is going to be the cash flows that you get into this. Now, to look at this on a more complicated spectrum of this is a lot of customers don't pay back the loan in full. Okay. So maybe they prepay. Prepay means they pay the loan off faster than the amortization schedule of this loan. So what ends up happening is you collect less interest. So while you issued the loan and you were expecting to collect a set amount of, cash flows from this loan or this product that you've got, you're not going to be getting that cash back here. So that's a risk. That's prepayment risk. Then you have default risk. Now, apparently, I didn't know people didn't know this, but lots and lots of people default on loans. Like they just don't pay it back. And often too, it's like, you can't afford the loan. Maybe it's the house, a car, something else. And you just sell it. You sell it to somebody else. You collect the cash, you pay off the debt, or you take the car back to the dealer or whatever. And you say, I can't pay this anymore. I'm walking away from the loan. And people walk away from loans all the time. And you just default on this sort of loan. It's much more common, I think, than most people that are probably watching this channel realize, but that's a default. So now when it defaults, there's a big loss in that. Now there's a loss in that on a variety of things. You get the asset back, you have to resell that asset, hopefully to get rid of it, to get it off your books, to send it to somebody else, make another loan. There's also the loss that you're just not going to get any more of those payments, right? That's another issue now. Now you borrowed money somehow, the cost of funds there. You lent it out to somebody else. They defaulted. Now you take the loss. You got to figure out what to do here. So when you look at this strategically, just on the loan side of this is how do you do that? Well, there are a slew of models that are going into this. So when people apply for loans, again, well-established firms are going to have fraud models. So you will have a statistical, mathematical, or machine learning based model that takes in a bunch of data on consumers, specifically the consumer that's applying for this sort of loan. And it's trying to figure out, are you a valid consumer? This could be corporate banking as well. So you're trying to figure out, is this a valid entity, right? Is this person actually getting this loan? And yes, fraud is much, much more common than the average public thinks. And so institutions spend a ton of time and money on building models for fraud. The other piece is going to be, what's the probability of default, prepayment, full payment, how much cash we can collect, what interest rate should you give that consumer? So you have a couple decisioning pieces here, right? They go through the fraud check. Then you have the originations piece of, do we want to originate this loan? Do we not want to originate this loan? Again, now you're looking at diversification of your portfolio, of the mix of scores that you have here. So often large banks will do prime or super prime, which is like the best of the best piece here. So they're going to be issuing those. They might not want to do subprime. Now you have other banks that specialize in subprime and deep subprime. And you have parts of the economy, which I would say is the unbanked population, which is people that are so risky, they don't often get traditional banking routes, which is whole other issue. But anyways, you have all these different components and pieces and you have all these models. So you might have a fraud model, an origination model, a default model, an LGD model, which is loss given default, which is another probability that goes into this calculation of predicting out losses. And then you have something called EAD, which is exposure at default, which this is all part of the standard, what's called the CECL approach, the current expected credit loss approach here. Anyways, it's PD times LGD times EAD gives you EL, which is expected loss. You have to do all these modeling just to be able to make a loan. Now you have the whole operations side of this. So again, what impacts, again, that exposure at default, which is if they default, how much of that loan is available and how much can we get back and how do we recover losses? You might have a bunch of operations and servicing models. So you have models that predict like Who should we call first, second, third, and fourth? How often should we call them? There are regulations that prevent you from calling more than so many times. There are ways to contact people, but taking a strategy on like when to call them and how to call them. These are all behavioral scorecards or behavioral models for predicting servicing. You might have the same thing for repossessions, right? Some loans you might should repossess because it's valuable. Some loans are probably very unlikely you're ever going to be able to collect them. It might even cost you more money to repo the car, so you might just leave the car. You need a model for that. There's all these models that bake together here, and now if you're a big institution and you're looking at this from a strategic perspective, you're also looking at things such as macroeconomic effects. So now you're modeling out stress testing, which is what CCAR and DFAST was for the banks here. And so you're modeling out, balances and expenses for the bank and the institution. All these things start to really come together here. And what I'm rambling on about here is I'm trying to get you guys to understand there's a lot of models, and this is just on the credit side. Now, there are areas of the bank where there are not very model driven. Investment banking, for example, is often analytics driven, not model driven. And what I mean by this is, let's say a new startup firm starts and they want to IPO. So they want to be, put on the stock exchange and have stocks and sold to the public here. When this happens, you have to find a firm that's similar to them and you have to try to value them. There's not a lot of data. So you can't build a statistical model that prices and IPOs all these different firms. Now, you could if you had enough data and you could put things together, but often these things are done analytically in Excel sheets. You try to find comparables, so firms that look the same, that have similar cash flows, that have similar risks, that have similar industries, and you put all this information together, you do analytics. Now, this is non-modeling, so I'm going to exclude all that. So in a bank, you have a lot of model-driven pieces, and anything that can be modeled will be modeled, because modeling is far more accurate and it gives you a competitive edge, which is what we're trying to talk about here in this video. So now imagine, going back to this loan example here, right? You have a cost of funds. You need to figure out how much to charge for interest rates and all that for these loans. Well, just because you pick a rate doesn't mean the customer is going to take that loan, right? They're going to go to 4, 5, 6 banks and they're going to pick the best one. So you still have a competitive market now on top of this. And then when you start to go down the chain, you go from global banks down to like big regional banks, down to local, like community organizations. Everybody's competing, but everybody has different costs. So they get their money at a different rate. And then on top of that, you have to figure out how much to charge based on the probability of default. But when, Dimitri comes through the door here and I'm standing here wanting a loan, what's my probability of default? You're not gonna be able to look at me and say, he's got a, 80% probability of default. Like, it's just not gonna happen. You have to have models to do that. And so when you go down this food chain, the big banks are often more competitive and have better profitability through volume. So now you have this volume piece here, which many of you probably don't think about, which is if I charge everybody a lower rate and I give them a better price, right? I'm gonna get more loans, I'm gonna get more volume, I'm gonna win more of that market share here. But the key issue here is, are you going to be able to make a profit? Because if too many of those loans default, then you lose money and then you go bankrupt. So to answer this question, right, does model development actually make a big difference? Yes, it makes a huge difference. Now, when you're a CEO sitting on top of these massive firms of 10, 20, 30, 100,000 employees or something, it is now challenging to answer that question, because I'm talking loans and products and servicing and this big chunk of the pie of the bank here that I've been doing, but you also have investment banking. Investment banking might be a bigger part of your portfolio here. You might need to put more investment into your analytics teams and less into your model development teams. Again, you might have data constraints, you might have other issues and kind of nuanced details that prevent you from building very rigorous quantitative models here. You might also have other areas of the bank like wealth management. Again, all this is going to be driven by models, because wealth management, there's a lot of data available. There's a lot of modeling and theory all behind that that's already been established as the industry. So most banks are going to use a ton of modeling to get some sort of edge here. Now, the debate I consistently run into, which I think is what most CEOs don't understand, because they're sitting up here and they have all these layers below them. They're not interacting with the model developer that's on the bottom actually building the model. They're working with the head of risk management, the chief risk officer, or the head of model validation or head of model development, and they might have 40, 50, 60 employees under them, or 100, 120, depending on size and a whole bunch of other factors. But they don't know, guys. They can't look at all these pieces here. They just don't know that. So when they see it, they see a dollar value and they say, oh, we need to make a cut. We're going to cut model development because it's very expensive here. How much value is your model development adding? That's a challenging question to answer. The big debate, though, as I've kind of been hinting at here, is that model developers are not all the same. And this, I think, is what drives the business absolutely insane. Like CEOs, they can't grasp it. They can't figure it out. Model development is not a science, okay? If it was a science, we would build a model, we would have a table like actuaries do. We'd look at the table and we'd be 99% accurate, and that would be it. But that's not how it works. Model development, markets are consistently changing and moving. There's a lot of complexities. Models are nothing more than approximations to reality. You can never get a perfect model. And the quality of models differs greatly. You will see a very, very large difference in the quality of models. Now, judging quality of models is challenging. Accuracy is what everyone's going to be focusing on. But the other piece is robustness. So how often do you have to refit a model? Because that is a business cost. Also, it reduces your risk because now when the markets change and move, your model's able to halfway keep up with that and not fail. You might have really highly accurate models that are overfit and they fail very fast. So, and again, there are probably over 100 to 200 different questions and variable selection processes and things you're looking at as a model developer. Someone who is very, very good at this, even if they give you the blueprint. So I've done time series modeling for a big portion of my career. I always teach it and train junior staff and explain these are the steps you go through. And oddly enough, no matter how many times I teach it, we always end up with very, very different models. And my models, of course, tend to win because I've been doing this for so long. I understand the business, the nuances, the information that you can't just automate into the process here. I know when to drop things. I know when to look at weird new methods that, I only use once every couple of years because I only see this problem every so often. And so, there's a lot of details inside of this. And doing this model development, doing this sort of process is very, very challenging and unique. And I would argue quants, we had this debate at work with a few of my colleagues, how much of a quant's job is scientific, like math driven, and how much of this is going to be creative, artsy driven. I would argue, my opinion has changed a lot over the years, but I think it's probably about 50-50. The creativity, the uniqueness, the skill set, understanding the business piece of it. Again, having a deeper toolbox, so more methodologies, more mathematical methods, looking at this from different points of view and perspectives can build you very unique and different models here. So there's going to be probably a marginal cost to this as well for banks. And that's, I think, the piece we need to think about here is you bring in a quant, you hire them, they build a model. What is your average student going to come in at? Let's say, I don't know, it's at some score out of 100, say 50. And then you bring in a professional quant, takes you to 75. Cost, you think about salaries and comp there, how far is that going to get you? Now, as a bank, are you strategically trying to get an edge over the other banks, or are you happy with the market share you have? That's going to be a big factor too, because the more fine-tuned you get, the more competitive in the marketplace you want to get, you have to get better and better models to be able to pick out the loans that are mispriced by all the other banks, which is a strategic advantage here. Also, you want to be able to figure out what other banks' costs are, figure out what other banks are going to come in at, and then figure out how do you cut them just a little bit. Like, how do we minimize our losses, but also maximize our return? And if we're trying to pull volume now into this equation, how do we crush those little guys? And how do we bring in the best pricing dynamics here? So you're kind of balancing volume and profitability and rates, and there's a bunch of pieces all going into this. But in general, you guys should start to get kind of this picture here that models play a massive role. Like, even when you go out and you apply for a credit card or you're pre-approved, there's a model that's already looked at your profile, looked at your information, and made a decision here. So models are critical. On smaller institutions as well, they are far less competitive than big ones just because they don't have the models. So there's a lot of stability issues in there. On the diversification piece, as I kind of mentioned in the beginning, there's also a lot of facts that banks specialize in one area. So model development's very expensive. So they'll focus in like one area, like say like prime markets. And then they will go out and diversify by buying product that's subprime or in a different type of product they don't currently originate or work in, and they will buy those and bring them into their portfolio. So hedge funds do this as well, which surprises a lot of people. Banks will originate loans, they securitize them, they package them, and then they sell them to investors and hedge funds and other sorts of banks. So models play an absolutely critical role in a bank. Unfortunately, most of you just don't see it, right? Because it's so smooth and there's fancy technology and you get a decision almost instantly. That instant decision is not coming from tech. That's actually coming from a model behind the scenes that's going out, grabbing a bunch of information about you from different bureaus and all that sort of stuff, compiles it all down, runs through a mathematical equation, which is the model prediction, and gives you some sort of answer. And then there's a whole strategy team that makes the decision based on volume and rates and all these other factors that play into this. So anyways, I hope you guys found this video helpful and a little bit insightful on the use of models and the need for models. I hope you also get the takeaway that CEOs and executives often get so far from these problems, and often getting a dollar value impact is very challenging on how do we get better quants? This is something I struggle with running a quant team. Like, how do you get better quants? How do I get the most value out of my quants? It's a very, very hard and challenging question to answer, and there's no simple right answer. So executives will make decisions at the high level, and then they kind of monitor and see what's going on, and then they might have to end up turning back to more model development and hiring better quants. But again, they also rely on the heads of validation, CROs, and heads of model development to figure those sorts of things out. So anyways, thanks for listening. Thanks for watching. And as always, until next time.